and not only in a pass for bridging, but a pass for CTA, for PDDA. How was the week?
So good, Shem. It was okay. Yeah.
Were you able to get through the work?
Yeah, I managed to do 2 PQs for FREP and MAFC.
Sorry, I lost you there for a moment.
I managed to start with PQs for FREP and MAFC.
Oh, awesome. The work that was covered this week was financial reporting systems, I think.
Yes.
And for MAF, it was just costing information.
Yes.
All right. In your own words, what was it? Was it quite a difficult topic? Was it a challenging topic? What was difficult or what was challenging this week?
What's challenging with FREP? Sorry, let me turn that off. What was challenging with FREP was doing the adjusting journals. I don't get them correctly. And also adjusting for the loans. 1 minute I get it, the next minute I lost it. Then with MAF, I think I did understand the content, but when I was doing the PQs, I didn't see that I was supposed to use the high-low method. Calculating break-even was difficult because I didn't know how to calculate the contribution. I'm used to having selling price and variable cost, so it was difficult. I only had selling price, so it was a bit tricky.
Okay, so what I'm going to do, you're right, today, for both FREP and MAF, all right, because for both FREP and MAF, it's very very fundamental. I want to say fundamental, but it's not something that you will be tested on directly.
Yeah.
All right, you will never be tested on adjusting journals. All right, a 15-mark question. All right, you will never be tested on contribution or break even directly. All right, yeah, they'll maybe ask a break even analysis or cost volume profit analysis, but it's part of a bigger kind of picture. All right, so what I want to do for the first half an hour of every session, I want to just give a general overview or of what I think the topic should have highlighted, right? From a theoretical point of view. Then maybe what I can do for the next half an hour is show me those questions and we can jump into that. And then we can see where we can help you with that question. All right. If that's okay with you.
That's okay.
Okay, so I think I'm gonna for this session I'm gonna do FREP, all right, and then I'll do MAF the next session. I wanted to check with you. Will it be okay if I'm not sure what your day looks like? Remember, I said I was trying to figure out my times. All right. Will it be okay for you if what does your day look like today? Can we have it immediately after this? All right, maybe have a 10 or 15-minute break, or can we have like maybe later this evening?
10 to 15 minutes break will do.
All right, so let's do that then. So we're gonna have 10 minutes, 15 minutes break, and then we continue. All right, and then we can bed it down. Then I know we sorted for the day. All right. So the two things I just need to keep for you to have ready for me is just the questions. All right, that you were doing the PQ questions. Do you have it as a PDF or do you have it as a or you can just, if it's a PDF, maybe you can just send it on the chat for me, on WhatsApp, and then at least I'll have it with me on the side. Or you can just share it from your side if it's something that you have. Okay, so let's jump into FREP. All right, and so if I'm not looking directly at you, please excuse me, just because I've got another screen here and I'm having my notes on the other screen. All right, so essentially this whole financial reporting systems module, all right, and financial systems is really, all right, I want to say it is the essence, it's the reason why we do accounting. Right? If it was not, if we didn't have a system to report, if it wasn't understanding about why we do things, then we would never have an accounting. All right. So this whole module, or this unit, if I can put it that way, is trying to frame your mind to say, all right, why do I do this? And what's the reason for it that I do this? So as an example, all right, you want to you want to understand what the purpose of a financial reporting is, and all right, why do I do it, and what's the purpose for it? You want to recognize the role that financial information plays, all right, and then you also want to identify the different components of the financial statements, all right, and basically understand, you have a framework for it. Now, it might seem very like, okay, but why do I need to know this? The thing is, if you know how these things are put together, then you will have then the understanding of how it gets interpreted by the users of financial information becomes important. All right, because if you think about it, you're actually not preparing this for yourself. You're preparing this for users of financial information, and users of financial information could be banks. Users of financial information could be investors. Users of information can be shareholders, even employees. All right, you've got all of these stakeholders, and really what you want to do is present this set of financial statements, all right, in a way that these people can make sense of it. Right now, this is so when you get into this frame of mind, if I can put it, the reason why you're doing this is really because you want to have some standard, right? Because the challenge that you have is that if there's no standard for doing something, you're going to do it one way and I'm going to do it a different way. All right. But you might have the same shareholders that I have, and I might have the same shareholders and you have. So when they look at your financial statements, they read it in a certain way. And then when they come to my financial, then they don't know. All right. So this whole idea of financial reporting systems is to build a standard that is consistent. All right. That whenever there are stakeholders of information, that it doesn't matter what kind of financial statements they read, they'll be able to interpret it in the same way because both individuals or both entities have prepared the financial statements similarly by using the same standards. Does that kind of make sense? So essentially, what you want to do is you really want to understand that that there is a conceptual framework that is being applied. All right, there's a conceptual framework that is being used to be able to say, how do I prepare this? What is the framework? What is the standard? What is the objectives when I'm building this framework for preparing financial statements, so that when I'm building this framework, I have some consistency in application and some consistency in understanding, so that whoever it is that is taking up these financial statements can use it consistently. All right. So a very important thing then, therefore, of financial statements or the characteristics of useful financial information systems is, number one, it must be relevant. All right. So why is something relevant? Something is relevant because whoever's going to use it, they're going to use it for a decision. They're going to use it to say, should I buy a share or not? Should I sell my shares or not? Should I invest in it or not? Right? Is this company doing well or not? All right. Um, so so um, so the whole and idea around this fundamental characteristics that they need to be is, number one, it must be, the information must be relevant. Also, relevance also speaks about the materiality of it, so that whoever is reading it, all right, it is something that they can apply and assimilate with their circumstances. So as an example, all right, um, for a shareholder, revenue might be relevant, right? So you didn't want to exclude the relevance, all right, there. For an owner, for an employee, revenue might not be relevant, right? The ability to continue as a going concern might be relevant because my job is at stake. All right. So it's I'm trying to amplify the understanding of this relevance from different stakeholders' point of view, so that you need to know that I can't only prepare the set of financial statements for the relevance of one individual. I need to prepare it generally, so that when I'm using it, whichever stakeholder is picking up this financial statement can use it for their purpose, all right, apply it for their purpose. Then, very important, right, a very fundamental characteristic is that our financial statements must be faithfully represented. Again, it seems like counterintuitive when you say, okay, David, but am I ever going to be tested on whether the question will say what is the qualitative characteristics or what the fundamental characteristics of financial statements, and should I be? No, you're probably not going to be tested on it. The important principle that I want to highlight through this foundation, if I can put it that way, is that when you start thinking like this, all right, of the reasons and why things are being done this way, then you're going to actually understand when you're reading a IFRS standard, when you're doing revenue recognition, or when you're doing PPE, or when you're doing leases, or whatever it might be in terms of a standard, you're actually going to now start to understand why certain things are done in a certain way. And the reason for it is linking it back to faithful representation, and is linking it back to relevance. All right. So on its own, it might not give you all the comfort right now. All right, because you're studying something that is never not going to be part of a test or an assessment. But the important thing, that is what I want to highlight here, is that grounding of the foundational understanding is actually going to be the impetus, is going to be the catalyst for how you read a standard, how you read deferred tax, how you read foreign transactions, as an example. All right, because if and then you're going to understand why a calculation is done a certain way, why you have to disclose in a certain way, why you have to show this in a certain way. Why? It's all because of relevance, and it's all because of faithful representation. All right. So now you're going to see, okay, whenever I'm now getting into a standard, all right, my mind is going to go back to conceptual framework, right? They might, and I say this with limited knowledge, because of course I can't say how the questions will be asked in a test or an exam, right? But and you'll see as you prepare with past papers, they might provide some leanings to how these certain questions get answered, right? Now, the next part of this is that some of these characteristics we want to enhance. All right. So we spoke about relevance, and we spoke about faithful representation. And now we want to enhance those characters. How do we enhance those characteristics? Number one, we enhance it by comparability. So if you think about it, you always have two sets of financial statements when you're reporting, right? The prior year and the current year, right? Why do you want to show the current year, prior year, right? It's comparability. In other words, it's a user financial statement. If you come back to what we're trying to do, is we're trying to faithfully represent, we're trying to give users of financial information, relevant information to make a decision. All right. So if this user of this financial information now sees the prior year, they can say, oh, there's a trend. Revenue is increasing. It grew from 10% year on year. All right. The gross profit is increasing. It grew 10% year on year. All right. But now the net profit is decreasing. So now the user financial station is going to say your revenue increased, your gross profit increased. Why did your profit decrease? Can you see what starts to happen is that only comes through because of the comparability of the information. All right. Then verifiability. In other words, can we then place reliance on this? All right. Can we verify this information, and how do we support what it is that we're saying? All right. We can't just say revenue is 10 million rand, right? But there's no bank statement to show 10 million rand. There's no invoices to show 10 million rand. All right. There's no customers to show 10 million rand. All right. Then we speak about timeliness. All right. And you know, from an accounting point of view, I'm sure you did accounting from school or undergrad level, all right, that accounting is based on an accrual principle. right? Accrual principle basically, simplistically put, is the expense happens before the income. All right. And so, what happens with this timeliness is to say that even though I didn't get the cash, even though I didn't get the money, I must recognize that I've earned it. All right. If you think about the definition of gross income is income earned or accrued in the year, I mean, received or accrued. All right. So in other words, we're saying whether you receive the cash or not, if somebody owes you that money, it means that you earned it. All right. And if they've earned it, that timeliness, all right, of that information now needs to be represented in the financial statements. And so you may remember me when we get to revenue, all right, because it's in the revenue standard that timeliness now gets amplified. Where did it start? It started with this conceptual framework. All right. It started with, all right, the reason why we're doing things. It started with the stakeholders. It started with this relevance of information. It started with faithful representation. All right. That then unpacked and said, because every standard is going to ask, the way we are doing this, is this faithfully represented? Every standard is going to ask, the way we are doing this, is the information relevant? All right. And can users' information rely on it? Is it verifiable? Is it understandable? That's the last one. All right. So you don't, because you don't want to things, you don't want to appear to look like you're hiding things. All right. Because you want to build confidence in the users of the financial information, that whatever information that they are using, that they are applying it, that how they are using it is how they expect it to come out. All right. No, you don't want to use something. You don't want to use something and realize, oops, actually, I misunderstood it. Actually, it wasn't like that. All right. And this is where this whole standard comes in. All right. Now, you would have already picked up also through this conceptual framework, and this is possibly where some of the theory comes in, maybe even from an assessment point of view, all right? Because you've got these different elements of the financial statements. You've got assets, you've got liabilities, you've got equity, you've got income, which includes revenues and gains, and then you've got expenses, of course, which includes losses. Now, the question is, all right, what is an asset, right? What is the liability? What is the equity? What is income? What is expenses? Again, coming back to this whole conceptual framework, understanding it's not just because I want to group things together. I want to create a standard to understand what this means, so that I know how to categorize whatever happens in my business. All right. So you're going to find different questions. All right. We're going to get into PPE next week, I think, into assets and PPE. All right. You're going to, the first thing you're going to know is this an asset or not? Right? On what basis is it an asset or not? If it's not an asset, then you can't use that standard. Right? You can't use IAS 16, all right, to be able to account for it, if I can put it that way, right? All this whole thing starts with the standard. It starts with categorizing it. It starts with understanding how to define what it is that you use, right? Now, that's what I'm saying. Sometimes it doesn't appear that this is a very useful topic. It doesn't appear like, why am I supposed to do this topic? But it creates the bedding ground actually for every other standard, all right? Because now you've got to understand, oh, the reason behind this is the relevance. The reason behind this is its applicability. The reason behind this is because I want faithful representation. I don't want to report an asset as equity. And I don't want to report an equity as liability. All right. I don't want to report an income as an expense. All right. It sounds very silly, but it's that definition that makes it actually important. All right. So some of this is going to be amplified as you get into the next level of things. All right. But the definition of an asset, all right? A definition of asset, it is a present economic resource controlled by the entity as a result of past events, all right? So what are we saying about that meaning? What does it mean? Or basically means, all right, I've got something, right? that I can use to generate revenue. That something is in my control, right? And it became in my control because of what I did in the past, right? Now, this is important because if, for instance, that's why I say I might be jumping ahead, but I want to give you this contextual understanding. If you think about, for instance, and I'm sure you would have been familiar with it, between a finance lease and an operating lease, right? A finance lease, all right. I'm basically renting something and I'm using it as if it's my own, right? Operating lease is basically I'm just renting something and I must give it back when it's done, whatever it might be. And we're not going to get into the depths of it right now. But the point here is that a finance lease is classified as an asset, right? Why is it classified? Because it meets its definition, right? The definition says it's a present economic resource, which, let's say you hired a tractor, all right? It's economic resource, all right, that is under your control. You deciding what to do with it, how to use it, right? There's no influence from the person that you rented it from, right? To decide, oh, you can only use it on this day, or you can't use it on that day, all right? You can only use it for so many hours or whatever. But that person gives it to you and they walk away, all right? And essentially, then this control is brought about by a past event, whether it be a contractual agreement that you entered into, all those kind of things. Can you understand now that the definition, all right, provided help, all right, to amplify why certain things are done in a certain way, in a certain standard, right? So this is why this bedding ground for understanding what is an asset, what is a liability, what is the income is so important, because you need to find yourself, oh, this is the reason now why the stand. Now, one of the, particularly in FREP, one of the things that I encourage people to do is that, all right, understand as you get into it, and you'll notice it as we continue, as you get into specific standards. The one thing I'm always going to ask you to do or consider upfront is to say, why do I have the standard? How did it come about? What is the complexities of the standard? What is the nuances of the standard? And how is the standard laid out? Right? Because it's that contextual framework, high level perspective, all right, that helps you actually just put things together to bring about an understanding. Right? A lot of times a lot of times our learning generally is progressive in isolation. I think I should copyright that. Our learning is progressive in isolation. What it means is that as you start with lesson 1, you go to lesson 2, you go to lesson 3, progressive. But what we've done is we've done those progression in isolation. In other words, you look at lesson 1 and we got lesson 1. Next, we move on, we look at lesson 2 and we got lesson 2. Next, we look on lesson 3, we got lesson 3. We've done the learning in isolation. Now, the challenge with doing that in isolation is that when you get to an assessment, all right, the assessment is not going to test you only on lesson 1. It's going to look at the integration of lesson 1, 2, and 3. All right, if there was those 3 lessons in the topic, all right, and see how this fits together. So this is the reason why this beginning of every topic is important in terms of getting that high level perspective, because when you've got that high levels perspective and you now go to lesson 1, you can see how it connects to that. When you go to lesson 2, you see how it connects to there. When you go to, and so you then create some cohesion between each of those things. And you'll see as you step into this bridging program now that the assessment is very different, all right, to how you would have done in undergrad. And part of the reason, I'm not saying all of the reason, part of the is how these questions gets asked and how the integration happens. So we spend a whole lot of time in building the content, but we don't spend enough time on how that content fits together, all right? And so you find that you have the knowledge, but you aren't able to apply the knowledge. All right. And that's part of what we're going to do through this tutor session. And now I digress. All right, and so then you've got a liability. I'm just going to run through this again. Liability is the present obligation of the entity. A present obligation, in other words, you are under. You are there's a I don't want to use the same word, but you're forced. All right, there's a demand placed on you. That's what I'm looking for. All right, to transfer this economic resource as a result of past event. In other words, essentially what we're saying, the asset is you receiving, and the liability you are giving away, basically. All right, equity. All right, and this goes without saying. The basis of accounting is built on the accounting equation. Don't forget the accounting equation. Right, accounting equation. Believe it or not, we put this thing to one side, we forget about it. It seems like we've never done it in our lives, right? But it's the bedrock. And if you understand how these things, then suddenly you'll actually see how a lot of things make sense. All right. And in this case, the equity is the residual interest in the interest after the entity is deducted all liabilities. And that is really the accounting equation. Owner's equity is equal to assets minus liabilities. Right? Assets minus liabilities is the net assets of an entity. The net asset of an entity is equal to the owner's equity. Again, it might seem very stupid or simple, but sometimes, and when you're going to see this, when you come into groups and when you come into consolidations, right? Sometimes we don't understand what is net asset. We don't understand the relation between net assets and owner's equity, right? That basically it's the same thing. And so when a question and assessment gets asked to say that, all right, that entity P, the parent, is buying entity B, entity S, the subsidiary, all right, and they are purchasing the net asset value of the entity, they're purchasing the equity. In another question, they're going to say they are purchasing 20% of the equity or 50% of the equity. It means they're purchasing 50% of the net asset value. All right. So the assessment is going to say certain things. The information is going to look differently, but they're actually going to be the same thing. Right. So if I make a very silly example, they might say that entity A is purchasing 50% of the net asset value of entity B. But in the scenario, all right, they give you the owner's equity. All right, and now you're like, I'm looking for the net asset value. Where's the net asset value? All right, what am I trying to do through this? I'm trying to show you the connection and why this topic appears to be irrelevant, stupid. I must spend all of the time. Why must I go through it? No, we're trying to show you that the understanding and the conceptual understanding of this terminology, and why when you now go further into different standards, like I said, now groups, I showed you the example of leases, whether you get into revenue, if it's 15, whatever that might be, all of that actually is going to then show my allow me to use this word, my conceptual understanding, right? Which comes back to this conceptual framework, all right? And so now you'd hopefully pick up, all right, the way I'm trying to do this tutoring session, and you'll see this as we go through, and I guess this is where I mentioned to you when we were speaking the other day, all right, where that you're going to have a distinct advantage, all right, is because when you learn in isolation, right, you can't actually extract the greatest value out of a topic because you don't know what's important and what's not important and where it's going to be needed. What we're trying to do through this kind of tutor session is to say, hey, you've gone through this, right? Right. And instead of just brushing it off, consider this, consider that, be aware of this, be aware of that. Your thoughts?
I think now it makes sense why the foundation should be strong. Like you shouldn't, if you don't understand lesson 1, unit 1.1, then you're gonna struggle when you got to Fed tax or other topics. Now it makes sense because I struggled
100%.
that last semester. Yeah.
Yeah, 100%. All right. So what is this session for me about? All right. This session for me is not about trying to teach you the content again, particularly today. All right. This session for me is to contextually, all right, provide some perspective to influence how you amplify your comprehension of certain things, right? So it's about saying things that you thought are not important, you will now realize is important. But things that you may have thought important, you can actually discard and say, actually, no, this is actually where it is that we are going and why certain things. And a lot of this, like I made some examples, which you're already familiar with. You're already familiar with the accounting equation. You're already familiar with financial leases versus operating leases. These are things that we are common, but we've never made the connection. All right. And so because we've never made this connection, again, it's this um, difficulty or barrier that we have of learning in isolation. All right. And I want at the outset to kind of break that barrier, right? By making these connections, and you're going to actually find it's not only making this connection with this subject, it's making the connection with tax, it's making the connection with auditing, it's making the connection with management accounting and vice versa, because essentially this is the disadvantage that us, and I say us coming from a disadvantaged background, all right, have, because we've never continued to see how things put together and why now it becomes difficult to consume certain information. It's not that we don't have the knowledge. It's not because we've never experienced it. It's saying, how do these things come together? And if you think about how and this is also part of what I want to do through this, is not only do the tutoring part, but also coach you, all right? So that whatever it is we're doing is we're establishing a way of thinking, a way of unlocking what I already have, all right? Because when you get to an IAC exam, all right, there's no distinction between what is tax and what is auditing and what in a question paper. All of it is put together. And so you now need to start practicing how that you must be able to think across all four modules as if they are one, right? How this connects with this, how that connects with that, all right? And the reason why we do things, all right? If you think about faithful representation, it's the reason why we do auditing, all right? Right?
Yeah.
Right? Because we want to ensure that what the management say about the financial statements fairly represents, all right, and it's free of material misstatement. All right, that's what you want to do. So the one can't be with the other, and the one doesn't necessarily supersede the other. Does that make sense?
Yes.
Now, if you look at so I'm just throwing this in here. Part of this is, of course, understanding all the financial statements that we have. All right, and we know we've got the statement of profit and loss and other comprehensive income. All right, we have a statement of financial position. We've got changes in statement of changes in equity. We statement of cash flow. All right. Of course, we've got disclosure. All right, and just generally, we got this presentation. This is all built up in this conceptual framework. Why do we want to do that? Because we want to build a standard so that when somebody is reading this financial statements, these stakeholders, all right, that standard, all right, helps them to make those decisions that is make appropriate decisions in respect of what it is that they are doing. All right. So this what's important here also is, and coming, I mean, again, I stressed this accounting equation earlier, where I said that the accounting equation we seem like when we get to postgrad, it's almost like that wasn't important, all right. I'm telling you, I work in finance. I don't know, in what you call it, in my division at the moment where I'm working. To this day, we go to the whiteboard and we do debits and credits, right? Because it's about tracing, and then you'll only understand a debit or whether something is a debit or credit when you understand the accounting equation. right? Assets increase on the debit side, decrease on the credit side. Owner's equity and liabilities increase on the credit side and decrease on the debit side. This conceptual understanding, all right, is exactly when you get to this adjusting journals, all right, that we're going to get into now. If you don't have this foundational knowledge of it, then when you get to doing journal entries, when you get to doing this adjustment, and these journal entries are one of the things that get tested so often, all right, because it tests your understanding of the standard better than just putting calculations. Right? Calculations is, multiply this by that. That's not the understanding. It's after you've done the calculation to say, what is the impact on the financial statement? Is it a debit? Is it a credit? Is it credit? Is it debit? Number one. Number two, which financial statement? And you'd have now picked up on all of these elements, I'm sure, right? Where you have in brackets in your journal entries, SFP, P&L, OCI, equity, all right? Where does that come from? It comes from the accounting equation, right? It comes from this conceptual understanding is, what is this that I'm dealing with? Is it an asset? Is it a liability? Is it equity? Is it an income? Is it an expense? All right? Now, hopefully now you can understand why something that seemed so irrelevant, so theoretical, all right, is now like, okay, now I understand. And the change, which is the smile that I'm seeing now, the change is really to say that that you actually pick up when that connection is made. Believe it or not, your enthusiasm towards the subject changes. Your idea of changes, your thought process changes, your whole look at the assessment, the question changes because you're not doing this because you want to pass time, right? You're doing this because you understand that if I've got this grounded, my next topic is going to be significantly easier, right? If my next topic is assets, if my next topic is business combinations, if my next topic is IFRS 15, revenue recognition, if my next topic is PPEIS 16, if my next topic is deferred tax. Now, here, take deferred tax as an example. Deferred tax can be a profit or loss item, and it can be a liability, a statement of financial position item. All right. So how do I know what it is? Right. And how do I apply it? And how do I decide whether something is this or whether something is that? In deferred tax, when you get to it, you're going to get deferred tax liabilities and a deferred tax asset. All right. Which is it? On what basis is it? How did I understand it? It all comes to this. All right. The deferred tax asset, it's an asset. So does that asset represent an economic resource that's controlled by the entity that as a result of the past event? If it's a liability, is that liability a present obligation of the entity to transfer economic resources? Now you're going to, when you go a little bit further, there's going to be things like provisions. All right. And then you're going to ask, okay, then what's the difference between a provision and a liability? And if you don't understand this, then you're going to answer the question wrong. And if you answer the question wrong, it's not because you didn't know the information, it's because you misplaced the information. And that's the reason why I'm coming back to this whole part of saying, all right, when you move from undergrad to postgrad, which is where you are now, you're finding now yes, the content, but it's saying, how do I interpret the required and match the content to the required, right? And so I know many people that they are brilliant students, right? But they failed, right? So your failure of the topic has got nothing to do with your intellect. It's got nothing to do with your knowledge. It's got nothing to do with your understanding. All right. What it has got to do with is say, how do I connect these things that I've been doing and avoid this progressive learning in isolation? Any questions so far? Right. So
Good.
So this whole thing for me, all right, is not to regurgitate the information. It's to provide relevance. And hopefully this is what you would have seen now, all right, saying, I've done this. How do I connect the relevance? How do I connect how how do I connect what I've done with what I'm going to do in the future?
Yeah.
Which means it's now going to put you in a position to say, do I really have the understanding? Right? And if I don't really have the understanding, all right, why is it then important to get that understanding? Right? So
For,
that
for,
yeah, continue.
for me to know if it's a deferred liability or asset, I should know the definition of an asset or a liability first. Okay.
Exactly. All right.
Yeah.
Because if you don't have that foundation, then you're not going to understand why the deferred tax liability definition. All right. And it's a very technical definition, but it's founded, its principles are founded in the definition of an asset.
Yeah.
And now you have to say, okay, how does this connect to the definition of the asset? Right? Why is it an asset? Why is it a liability? And on what basis? Right? Then that's going to feed into calculating temporary differences. It's going to feed into, all right, whether I debit my income statement or I credit my income statement, my P&L. All right. It's going to feed into all of those things. All right. And so you're going to find that when you get to journal entries, you might get the journal entry correct, but swapped around.
Yeah, I see that.
All right. Right. And then we start guessing. All right. Is it a debit? Is it a credit? Is it whatever? And then you just, I'm sure it's a debit. I'm sure it's a credit. Right. Now, if you just sat long enough to think about it, right, which is what we're also trying to do now, is to encourage consistent learning. All right. Not when it's under pressure. But if you sit just long enough, then you understand, of course it's a credit. I can see it. This is the reason why, whatever. Why did I think it's a debit?
Yeah.
All right. Of course it's a debit. Why am I thinking it's a credit? Because 1, 2, 3, 4, 5. All right. And you're going to then rely on actually your own knowledge of it, not what David said or what anybody says, your own understanding of it. And that's actually what I want to do different. All right. I'm not here to to um to give you additional knowledge. All right. I'm really here to amplify what you already know and make those connections. That for me is going to be the change in how you now become more confident, use your understanding, and for the application to be able to score the marks that it needs to be scored. Cool. Let's if you got any questions, hopefully that was a good and foundational introduction.
Yeah, it was good.
Awesome. Do you want to share the question?
Yeah. Yeah, I've sent it on WhatsApp.
Yeah, I've got it here. So what I'm going to do is let me share it on from my side. Okay. So what I'm going to do now is, all right, I'm going to connect this whole conversation that we've had, right, and amplify things, all right, so that you can see where the connections are and why, this is important. Because I think that's really the aim that I'm trying to establish through this session, right?
Yeah.
So I always start here, right? Prepare the journal entries, all right, to account for the loan from America Bank, all right? So maybe if I do this quickly, let me download it. Web tutoring, just save it there. And let me just do this so that I can highlight actually. Okay, there we go. So yeah, what they're doing here is they're saying, all right, what do I need to do? I need to prepare the journal entries. All right. What do I need to do the journal entries for? For the loan. The loan from. This is very important. All right. From America, America Bank in Renovate IT's financial statements. Why is that important? All right, because that's important because firstly, all right, if it's a loan from the bank, then this would be then classified as a liability. If it was a loan to, then it would have been classified as an asset. Does that make sense?
Yes.
Right. So that's the first thing. Secondly, all right, from whose perspective are we looking at this? From Renovate's perspective. If you're not sure, if you don't ground your understanding, all right, of whose perspective you are looking at, all right, you're going to find yourself again flipping things around. Right? Because if you were looking at it from, let's assume this was not the bank. It's easy when it's the bank. All right. But let's say it was Renovate and Rosina Pty Ltd. Now you don't know, all right, right? Because the relationship is not as clear, right? Because you're never going to lend money to the bank. The bank is going to lend to you, all right? Then you might again flip things around. Your debits become credits and your credits becomes debits. Your liabilities becomes assets and your assets become liabilities. Your income becomes an expense and your expense becomes an income. Where did this start from? It started from not understanding the perspective that you are from and who's doing what. Does that make sense?
Yes.
All right. So now we understand that. All right. They give us. I always just from exam technique point of view, always look at this when they provide things in bullet points. When they provide things in bold, you can see Renovate IT. In other words, they're saying, hey, it's Renovate IT's journal entries. All right. Tax related entries, dates, and narrations are not required. All right. So and then they're giving it for 9 marks. Now I go to this. All right. And they're telling me, and maybe if I open up a Excel spreadsheet here quickly. Right, so let me just do this again. Where's my spreadsheet? There we go. Okay, so essentially I'm doing Renovate and I'm doing the journal entries for Renovate. The company is founded in 2007. All right. Renovate has a 30-year June end, which means I've got 1st July, all right, to 30 June. All right, that's my financial year end, basically, of all my financial year. All right. Then they say this is for the 2021 financial year. So in other words, basically, I'm starting. It's ending in 2021. All right. Just do it like this. It's ending in 2021. But of course, it's starting in 2020. All right.
Yes.
Then they say, okay, during the prior financial year, Renovate's IT computer server was slightly damaged when it was struck by lightning. As a result, they decided to purchase. Right. So before I even go further, all right, I'm purchasing a server. All right. What is a server? A server is an asset. All right. So even before I go to this whole thing, if I'm going to purchase it, I need to say it's a purchase. All right. Is it cash? Or is it am I paying it off? All right. In other words, is it a receivable? All right. The server is an asset. Assets increase on the debit side. Cash or receivable, all right, is a asset which is bank. If I'm using cash, my bank is going to decrease, and my bank decreases on the credit side, right? It's going to, again, it's not a receivable, sorry, it's a liability. All right. So in other words, I'm going to owe somebody for the money to pay them off, and my liability increases on the credit side. Right. So can you see already I've got my debit and my credit, because I must balance. All right. Whatever I do on the debit side, I must balance with the credit side. So this is just building this understanding of what it is I do. Now they're saying to fund the purchase of the server, they obtained a 5,000 Rand loan from America Bank. The loan was paid into Renovate's bank account on the 1st of July 2020. So basically at the beginning of the financial year, which is here where I am, all right, I got this loan of $5,000, all right, and then they say the loan is repayable in 4 equal annual installments on the 30th of June, all right, so in other words, at the end of every financial year, and bears interest at 4.08% per annum. All right. So what they've done here is, all right, they've essentially combined, all right, the purchase of an asset with the funding of a loan and the repayment of a loan. All right. And so this is my purchase here. All right. And in this case, I'm actually not going to have a liability, because I'm going to use the loan that I received to pay for the server. Right? So the loan money is coming into my bank account. So therefore, this is back. All right. So already I know debit, PPE, and credit, bank. Right? And now I need to understand what the amount is and where this amount comes from. And so they didn't give me the amount. All right. They just told me that they got this $5,000 loan for it. I'm not sure if that is the amount that I'm paying for the equipment. So this is on the one side. Let me just do, where's this font, right? This is on the one side. So this is, call it the purchase, the asset acquisition. Let me call it that, asset acquisition. This is the asset acquisition. On the other side, this is the loan. Let me call it the loan received, right? So when I receive a loan, they gave me the money, all right? So I got the cash in my bank account, and because I get the cash in my bank increase, all right? So, and bank is an asset. The cash in my bank is an asset, and that increase. And because it increased, it's on the debit side. All right? When I got this loan, I then I have now an obligation to repay it. So I've got a loan, and I've got an obligation. Remember, coming back to this obligation that we spoke about, a liability earlier, about the definition. All right, this is a loan. I've got an obligation, which means this is now a liability, and liabilities increase on the credit side. Can you see immediately I've got my debit and I've got my credit? So essentially, I've got now my debit, which is my bank, and I've got my credit, which is loan, right? What I don't know yet at this stage, what this amount is. Well, I know what the amount is, all right? I know the amount is $5,000, but I've got a problem because and this is something we didn't mention earlier, but remember, you have a reporting entity, right? And the reporting entity has to report in the currency, all right, in which that reporting entity is domiciled, or the currency of the holding company. All right. Again, it's that principle of relevance. It's that principle of saying, I can't report in dollars when my stakeholders are in ZAR, in the rands. All right. So I must report in the currency that makes sense for where I operate, essentially. And that's basically simplistically put. So because of this issue here, now, hey, I have a problem. But besides the loan received, all right, the loan received here, I also have to repay the loan. All right. And if I repay the loan, basically what's going to happen is my loan is decreasing. All right. And if my loan is decreasing, it decreases on the debit side. And when I'm repaying it, I'm using my bank. All right. And my bank is also decreasing. All right. And my bank is an asset. On which side my bank? It decreases on the credit side. Again, can you see I've got my debit and my credit?
Yeah.
But linked to this loan, there's interest. Right. So not only am I paying the capital of back, I'm also paying the interest back. Right. So I've got an interest expense. Right. Interest expense. In other words, it reduces profit. Right. And because it reduces profit, all right, it's a debit, and expenses increase on the debit side. All right, basically. All right. Then you have bank, because you are paying it, and the bank is decreasing because you are paying money out, and bank is an asset that decreases on the credit side. Can you see again? You've got your debit and your credit there. So what we've done through this exercise really is actually forget about the amounts now. All right. Just what am I dealing with? Because the complexity, all right, doesn't change the foundation of my debits and credits. Now what happens here is you're going to now say, this is in dollars. Wow, I must use the exchange rate. I must do this. I must do that. All of the. Whoa. Okay. Yes, you're not completely wrong. But I'm also saying what you need to do is actually get to the bottom of what this is, because the foundation hasn't changed. And can you see what I've done here by showing you that?
Yes.
Now, again, this principle comes into play that I'm trying to bring across to you, is that when the foundation is strong, your accuracy of calculations might be wrong, but your debits and credits will never be wrong. Right? Which means you're going to lose the mark for the accuracy, but you won't lose the mark for the concept. And when they actually mark principles. All right? Because it's a principle that's important. You're going to get an additional mark for the accuracy, but you will notice when you look at mark allocation, the accuracy marks is actually very low. Because they can understand you made a mistake by using the wrong amount on your calculator, or you said plus instead of minus, or whatever it might be. These things happen, right? But principled application, you can't get that wrong. because then it changes the whole dynamic, all right, of what the impact of these transactions are and why these transactions happen this way. Does that make sense? Right. The last thing I just want to cover here then is once you've done all of this, what you do need to know is, in fact, is whether I use the spot rate at 1st of July, whether I use the spot rate at 30th of June, or whether I use the average rate. Right? And these principles, all right, we're going to speak about these foreign transactions at some point, I'm sure. All right. But essentially, whenever there's cash movement, whenever there's bank involved, you always use the spot rate on the day where bank is involved. That's the simplest way to put it. Right? Whenever bank is involved, whenever cash is involved, the spot rate is applied on that day. So if you think about that principle now, all right, you received $5,000 on the 1st of July. That was a cash movement. So your spot rate would be the spot rate on the 1st of July. So this transaction year of $5,000 year on the 1st of July, right? This is going to be $5,000, 5,000 times 13 Rand 90. And that's going to be 69,500. Does that make sense? Right? Interest, all right? If you think about interest is accrued on a daily basis, even though it is paid at a particular point in time. Right? So interest is always you always apply the average rate. Why is it the average rate? Because essentially what you should be doing is you should be calculating the interest every single day for every single spot rate on every single day for 365 days of the year, as an example. All right, but it doesn't make sense to do that, does it? All right, because now you must get the spot rate for day 1, the spot rate for day 2, the spot rate for day 3. No. All right, so for interest, any values that is accrued over a period of time, right? You then apply the average rate. So the interest portion here, all right, would then be the spot rate of 1330. And if you look at the table that they've provided you, basically is that here is the capital repayment at the end of June 2021. All right. So this is this loan repayment part, which would be the 30th of June 2021. All right. And this amount here then would be, remember we said it would be the spot rate on the day. All right. And then this interest expense here, all right, which is your interest is a debit, debit, and bank a credit. All right. This year would be using your spot rate, which would be then the amount of $204 times the spot rate, or I mean, not spot rate, average rate, 13 Rand 30.
If I wasn't given the amortization table, I was not going to use the 204. I was going to use the $5,000.
Well, you would have, if you were not given the amortization table, then you would have had to calculate it. Because you would have then used this interest rate that they're giving you, a 4.08%.
Because I was surprised, why did they use the 204?
Well, the 204 is the 204 year. Let me just see. That's the repayment. So no, so the capital portion here, the capital portion here would have been this amount of 1176. 1176 times the spot rate of 1360. Does this make sense?
Not really.
Okay, let me ask you, ask your question. What did they use?
They used 204 times 13.30.
Yeah, which is what we did now. Yeah.
Yes, but when I was
Okay.
doing this example, I used 5,000 times 13.30.
Okay, but you remember this why? Okay, let me ask. Why did you use the 5,000 rand? What did you want to do with the 5,000 rand?
The interest.
Yeah, but the 5,000 rand, the $5,000 was the loan amount. It wasn't the interest on the loan. So you couldn't have used the $5,000 to calculate the interest. If you didn't, you were not given the amortization table, you would have said $5,000 times the interest rate of 4.08%, right? Which means to calculate my interest, I would take my capital, simplistically put, all right, my capital, all right, times my interest rate. That's simplistically put. So if you would have then said it's 5,000 times 4.08%.
Okay. Oh, I forgot to use the interest. It makes sense now.
Yeah, you understand what I mean. So what they've done here is essentially they've said, all right, $204 and they've got 1176, all right, and basically that's what they've done. Now here's the interesting thing, all right, and so let me go to a new sheet, all right. Essentially on this day, 30th of June, they paid an amount of okay, paid to loan. They paid, how much did they pay? 1,380. You agree with me?
Yes.
All right. Which means they would have said, pay Bank of America, pay Bank of America this amount of $1,380 and then reduce my loan with the same amount. You agree with me? Right? Now, but here's a problem. In this payment here, all right, this payment consists of capital plus interest. You agree with me?
Yes.
All right. And we said to you that capital is using the average rate, and interest is, capital is using the spot rate, and interest is using the average rate. So even though the amount that you paid, because remember what we did say, we said whenever bank is involved, right? Whenever bank is involved, you're going to use the spot rate. All right. So basically, what you're going to do is you're going to use. Let me not say Bank of America. Just say bank. No, it's the other way around. Sorry. This is loan, is my debit, and bank is my credit. All right. All right. So basically, what I'm going to then do is this amount here is going to be, all right, is going to be times, let me just say dollars here so that I can, and say 1,380. Yeah. And then I'm going to say this is going to times my spot rate on the day, which is 30th of June of 13.60 Rand. So that's the amount that I'm going to be paying on the day. But I need to account for reducing my loan with the interest, right? Because there's the interest portion here. So you see this payment here went directly into my loan account. So if you think about what your loan account looks like, all right, your loan account looks something like this. I'm just trying to do a T account here for you, all right? The loan account looks something like this, all right? And here's the loan. All right. So when you got the loan, there was bank, and it was 5,000 times 1390. Right. Then when you paid the loan, you said bank. all right? And you paid an amount of this amount here, 1876, all right? But there's also an interest account. Let me just maybe copy this. There's also an interest account. And the interest basically is, remember, I'm going to debit my interest, all right? So in this case, I'm going to debit my interest. Let me just take this out. I'm going to debit my interest to my loan account, and I'm going to debit my interest of 204 times the spot rate on the day, which is 1360. All right, which is that amount there. All right. Now, to cancel this interest out, what I'm going to have to do is I'm going to debit my, so this is actually um, um, no, let me actually split this out. Let me split this out. My loan is going to be debit this bank of loan, just ignore the interest part here, all right, which is my loan amount is, what's my loan? 1176, and my interest is 204, right? So this is equal to that. All right. Yeah. All right. Does that make sense quickly? Yeah.
Yeah.
My interest is that amount. All right. And I'm going to debit my bank. Right. So essentially here, so this is going to be there. Yeah. So can you see now, if I look at this, all right, my bank here, I paid interest of this amount, and I paid that amount. So I paid basically 18,768. Does that make sense?
Yes.
Right? But if you multiply this amount that I actually paid to dollars times the spot rate on the day, which is 13.60. Let me just see, 13. Sorry, this must be 13.30. All right. So basically I paid these two amounts, 18,706 Rand. This is what I've recognized in my loan account and what in my interest account. But the physical amount that I paid to the bank is the 1,380 times the spot rate on the day. And can you see there's a difference between 18,706 and the 18,768, which is basically an amount of what, 62 Rand, 61 Rand something. That 61 Rand is because one rate was at the spot rate and another rate was at the average rate. That difference between the two, where I paid more, to the what you call it than what I was supposed to, is what they call a foreign exchange loss. All right. So I have to then make up for that, if I can put it that way, by actually showing another loss over because of the amount that I paid more than what I recorded it as. That was a mouthful.
Yeah.
It was a mouthful. Are we expecting well, am I expecting understanding here? No, I'm not expecting your understanding of the debits and the credits like I was doing it now. No. What I was trying to show you is the importance of this grounding of the conceptual framework and understanding the debits and the credits and the accounting equation. That's really what I was trying to do. All right. Now, what I'm going to ask you to do is we've went over time, much more time than what I expected to, but I thought this was important. What I'm expecting you to do now is to say, okay, I've been in this conversation now for more than an hour. All right. Let me situate myself around this and then take that and now go and see, where did I go wrong? Why did I go wrong? And what was the solution saying about this? Does that make sense?
Yes.
Cool. So let us, I need to leave home by like 11 o'clock. So I won't have much time, especially now because we went over this. Would would can we take 5 minutes? All right. Get yourself a cup of coffee or whatever, glass of water, go to the bathroom. Then we come back in 5 minutes, 10:20. And then I'll only be able to go until 11 o'clock. But if we need to catch up, if there's something else you need to know, we can take it from there. Is that okay with you?
Okay.
In the meantime, can you share any question that you have on the math
Okay.
so that we kind of just redeem the time as quickly as possible?
No problem.
Cool. I'm just going to mute myself and get myself a cup of tea and then be back at 10:20. Cool. Okay. Thank you. I got your questions. Lovely questions. I was reading through it now. Okay, so what I'm going to do in this session is I'm going to weave in some of the foundational understanding when we're going through the question, as opposed to doing it, right, separately like we just did in the first session. Just so that again, very important, especially I want to say very important for all modules, but in math, you've been part of that prep session, I'm sure, that exam prep session that we had, right? And I've got a special place in my heart for math. So, and I've seen that you're right. When you do certain things, we actually, again, this whole principle of progression in isolation, you actually want to bear down and see some of these topics. Last night, I did a session with a PGDA group on transfer pricing. All right, and everybody's scared about transfer pricing, but some of these principles that you are doing now, yeah, break even, net marginal revenue, um, um, cost volume profit analysis, and a few of these things, the contribution margin, and all of it. These are all the same principles that are just all brought together from a different perspective. And so if you understand the principles, then the topic of transfer pricing doesn't even bother you, all right? But it bothers people because they don't have this foundational understanding of the actual topic. All right. So if I look at I always want to start with required. I never go look at the scenario first because well, for different reasons, but one of the thing is you kind of want to situate yourself, all right? What it is that I'm doing, why am I doing it, all right? And like I've said before, you may have heard this, is that when I can unpack the required and understand what is expected of me and the required, then what happens is it's now not only is it not me reading just heaps of information. It is actually me going to the scenario and saying, what do I need and what should I look out for? So instead of all the information rushing out at me, I'm now saying, I'm expecting to see this. This is what I'm looking for. This is what I need to be able to answer the required, and then put those things together. All right. So if you look at here, right, firstly, again, whenever I see things like this, I always want to just kind of highlight, all right, they say calculate. What do I need to calculate? Do you need to calculate the following, right? All of this here, all right? You need to calculate all of that. And I'm not going to even worry about what all of that is, but I need to calculate the following for option 2 and option 3. All right. Immediately. All right. If I think about it, this is what I'm going to have. I'm going to have this. I'm not even looking at the answer, but I'm going to have option 1. And sorry, option 1 on this side, and I'm going to have option 2. And for each of these options, I'm going to have contribution margin, break even, profit ratio, and percentage safety. All right. So what have I done now? I've kind of given myself a framework. I've given myself a thing that when I'm done, I can ask myself the question, did I answer the required? All right. Now, generally what happens is when we jump into something, and you may find that you say you miss this. Sorry, this must be option 2 and option 3. Right? You miss this information, all right? And then you only do option 2. And then you wonder, why didn't you get to all the marks? Right? Because you didn't actually establish some frame to say, okay, when I answer this required, I will ask myself, did I answer the required? Yes, I did, because I was asked to calculate all of this for option 2 and option 3. All right. Now, what is contribution? All right. So now if I look at this, it's not saying contribution margin, it's contribution margin ratio. Right? It's not break-even sales in units. It's break-even sales in unit and value terms. Right? Then they ask you for the profit. Then they ask you a profit ratio. All right? Then they ask you for the percentage margin of safety. Now, all right, what is the contribution margin? Let's start there. In your own words, what is the contribution margin?
The selling price minus variable cost.
All right. So now we know it's selling. Let me just put it down here. Contribution margin, all right, equals selling price minus variable cost. That's contribution margin. All right. What's the principle of why do we call it a contribution? Right? Think about this. If you're looking at an income statement, coming back to the connection between this subject and other subject. If you look at the income statement, what does your income statement normally says? Sales, cost of sales, gross profit, right? Then you have other expenses, basically, right? Then you have total profit, simplistically put, right? Maybe I should have just moved this slightly down like this. All right. So from simplistically put, from a math point of view, this year translates to selling price, variable cost, and contribution margin. Can you see that?
Yes.
Right. So if you think about it, this gross profit that you're calculating here, all right, if this sales is, let's say, 200 Rand and cost of sales is 100 Rand, then basically my gross profit is 100 Rand. In other words, this amount of value that I created here is what pays for all of this. That leads me to a profit of that. Does it make sense?
Yes.
All right. So in other words, the value that I create on the top is used to sustain my other expenses, if I can put it that way. Does it make sense? If I only create value of so much there, is that sufficient to cover my expenses?
Please repeat your question.
Eh?
Please repeat your question.
Are you on? I can't hear you now. Sorry. I thought you were on mute, but you're not. I can't hear you.
Please repeat the question.
I'm saying if my cost of sales was 180 Rand here and I made a GP of 20 Rand, would this be enough to cover my expenses?
No.
No. In other words, I'll end up with a loss. Right? So
Yes.
so essentially what I'm saying is that this GP here is what is needed to cover this, to lead to a profit of this. Right? So from a management accounting point of view, my selling price less my variable expenses is my contribution margin. My contribution margin for what? To cover my fixed costs. All right? To lead to a profit of 50 Rand. Right? So essentially, my variable, my contribution margin is the contribution towards my fixed costs. That's what it is. Right?
Yes.
Now, this year is assuming that this is a total, right? It's small amounts, but it's assuming that's a total, that I've got 200 in revenue, 100 in cost of sales, 100 in GP, and have fixed costs of 50 that leads to a profit of 50. All right. Remember, fixed costs are fixed even if you don't produce, even if you don't sell, which means you're really going to incur that cost whether you have 1 unit, whether you've got 50 units, whether you've got 1,000 units. All right. So fixed costs, all right, are fixed regardless of your production, regardless of your volume. All right. And I say that very simplistically because we do understand at some point your fixed cost is going to increase when your volume goes over a certain amount. Right. But up until, let's say, 1 million quantities, your fixed cost will remain the same. All right. So over a certain range, your fixed costs remain fixed regardless of that. All right. So essentially what I'm saying is this: if this value that I just calculated here, let's say this was a volume of 100, then the unit price of this 100 would be that divided by 100. Right? Can you see that?
Yeah.
That my unit sales is 2 rand, my unit cost is 1 rand, and my unit contribution is 1 rand. So basically, what is this? This is saying that for every unit that I sell, I'm making a contribution of 1 rand to my fixed cost. Did my fixed cost change? It can't change. All right. So based on this, simplistically saying, yeah, all right, based on this contribution of 1 rand per unit, how many units must I sell to contribute to my fixed cost?
50.
50. You have just calculated break even now. Right?
Yeah.
Because essentially, when I'm now doing 50, let me just come across here and I say that times 50. This times 50. All right. And I have 50 there. Then my profit is 0. Can you see? Right? This whole thing is really not complicated. It's using what I already know.
Yeah.
Right? And just linking this, I call it an associative technique. All right? Because then the seemingly abstract topic is now not abstract anymore. And it's generally when things are abstract that we find difficulty in consuming or absorbing this learning. All right? And it seems like we're doing the same thing over and over and we're just not getting that breakthrough. What I'm doing here now is showing you this associative technique to say, oh, this is actually what this is all about. This is why it's called a contribution. All right. It's a contribution to what? Think about it when you're having a birthday party and everybody asks you to make a contribution. All right. It's in other words, it's what I'm going to give to cover the total expense of what is going to be covered. It's English. It's a contribution. You have to ask yourself a contribution to what? In math terms, this is a contribution to get to the fixed cost.
Yes.
Right. Now, this contribution margin ratio, right? You need to now get to a point and say, okay, what is this contribution margin ratio? And maybe let me ask you, what would you consider this contribution margin ratio to be?
Contributions divided by sales.
Contributions divided by sales, right?
Yes.
Why do you say that?
I don't know.
Hey? Okay, let's do that calculation. All right. So by using this example that we've got here now, you said it's my contribution, all right, which is 100 Rand divided by my sales, all right? So basically, if I look at it from a percentage point of view, my contribution margin ratio, it's saying it is 50%. What this is saying is that 50% of my sales is doing what?
It's my contribution.
There we go, right? So in other words, 50% of my sales is making a contribution to my fixed cost, right? So in other words, now I've got a relationship going here where I've got a percentage of my sales, all right, that is contributing to my fixed costs. All right. So if I look at this example here, let's look at this example here. All right. The 100 Rand. If I'm giving the contribution margin ratio, right, then I know it's the percentage of my sales that is contributing to my fixed costs. So if I take this 50% that I'm now already aware of, all right, so I'm going to say 50% of my sales is contributing to my fixed costs. So what is my sales? It's 100 Rand. What is my fixed cost?
50.
I mean, what is my contribution going to be then? It will be 50%, which will be 50 Rand. Now, here's the question. Is my contribution margin sufficient to cover my fixed costs?
Yes.
You understand where can you see the connection?
Yes.
Right? Now, let's flip it around. All right? If my contribution margin is 50%, all right?
Yes.
It then means to break even, all right, I must double my sales, double my fixed costs to equal to double my fixed costs must be my sales amount. Does that make sense?
Yes.
Because whatever I make in sales is 50% towards my fixed costs. So if I want to cover my fixed costs, then I need to make double my fixed costs in sales to make sure that I break even. Right? So how did we do that? We basically said 50 Rand, which is my fixed costs, divided by my contribution ratio. To get to my 100 Rand. Can you see that? So basically, basically the relationship here now that exists is saying, oh, so my contribution margin ratio is not just some ratio that I must calculate and figure out and remember, because that's what we do. We memorize this formula. No, it's understanding what it actually is and why it is there and how it can, the relationship between things. Because now I started from the top and I said contribution is 50%. 50% what? 50% to my fixed costs. Now I'm saying, let's start from the bottom. All right. And I'm saying, if my fixed cost is 50 Rand, how much sales must I make given a certain contribution margin ratio to be able to break even? All right. Now, in this case, you would have seen what I did here. I took my fixed cost of 50 Rand and divided it by my contribution margin. In other words, if my contribution margin was 25%, then I must make 250 Rand sales. If my contribution margin, no, well, 20%. If my contribution margin is 10%, I must make 500 Rand sales. Can you see now that relationship? The lower my contribution margin, the higher the amount of sales I must do.
Yes.
What does that mean from a business point of view? Think about this, and I'm trying to lead you to this kind of thinking. What does this mean for a business point of view based on what I just did now? Let me just do this, right? 100 Rand when it's a 50% contribution. 250 Rand of sales when it's a 20% contribution. 500 Rand when it's a 10% contribution. What does that mean?
I must sell more.
You must sell more when my contribution is less.
Yes.
Right? Which means I have now a higher responsibility, if I can put it that way, to do more sales to cover a higher expense, a higher fixed cost. Right? So can you see from a risk point of view, all right, I have to do more. So this comes to this whole risk of having high fixed cost, right? Because this high fixed cost is dependent on my contribution margin. And the higher my fixed cost is against a low contribution margin, the more I must do. So here's my questions. What if sales don't perform? What if there's a drop in selling price? What if customers don't like my product anymore? What if my quality of my product drops? All right. What if a new competitor comes into the market? Can you see all of those factors have now impacted my sales? And here I'm stuck with a fixed cost.
Yes.
All right.
Yes.
Can you see what we've done here? We've taken principal component topics and made the link amongst them so that you don't see this in isolation, and you can actually see why doing this calculation, that the contribution margin ratio, all of these kind of things is important. And maybe if you know it now, you've actually covered all of this A, 1, 2, 3, 4, and 5 by what we just did now. Do you think we've done it?
Yeah,
Yes or
I
no?
think so.
Huh?
I think so.
All right. So what have I done? I've not answered the question by trying to say step 1, step 2, step 3, step 4. I've not tried to give you formulas. I'm giving you understanding. Why? Because if you have the understanding, no matter how the question comes, you can break this question apart and still answer the required. Because you're now equipped with a foundational understanding of these seemingly abstract topics. Questions, comments, clarity, statements?
I'm good. I understand now. Because I used to cram the formulas thinking it's a good thing to do.
Now, I want to get you to move away from that as fast as possible, because you're going to find that that's where the disconnect is going to lie when in the manner in which the assessment questions come, the assessment required, all right, and interpreting required in terms of what needs to be done. So here it might be okay, but if you get to the exam, maybe it's going to be like, oh, now you're going to feel like you don't know anything, and that's really not the case, right? And this is when disappointment sets in, this is when anxiety comes in, this is when panic comes in, and then you will lose everything, right? We're upfront trying to now bed down this whole conceptual understanding, right? So that by the time we get to the more complicated technical kind of things, all right, our understanding is so bedded down that it doesn't matter how the complication comes. Remember, and this sounds very counterintuitive, but every difficult topic is underpinned by the basics. All right? You can't get to the complexity without building on the foundation. So I'm also saying that it's because when you get to a question, all right, that you might find difficult doing, start with the basics, because even the mark allocation is in the basics. So if the question is out of 10 marks, you're going to maybe get 6 or 7 out of 10 and you're going to miss the 3 marks where the complexity lies. Why? Because you've got a grounded foundation in the conceptual understanding of any topic, regardless of what the topic is, and you can put yourself and attempt it. Does that make sense?
Yes.
All right. So the one that I haven't really covered, all right, is this percentage margin of safety. We have, but not maybe we covered in a very subtle way. All right, because when we were talking about this contribution margin and our fixed cost here being 50 Rand, and in this case, how much sales I must do to get to, if the contribution is 10%, all right, basically, all right, what we're saying here is we're saying, okay, all right, if I come back to if I come back to this one here, all right, essentially, I've got a margin of safety, in this case, of 50 Rand. All right, because I've got 50 Rand of safety until I make no profit. Does that make sense?
Yes.
All right. So then the question is then, all right, my profit then, as a percentage of my fixed expense, my profit, a relationship between fixed costs, that becomes my margin of safety. And now this I need to represent in some way. All right. In other words, what I've got remaining, all right, is saying, oh, this means if my products, if my profit, in this case, my profit is my profit as a percentage of my sales is 25%. All right. This means my sales can drop by 25% before I run into trouble and not covering my costs. Now let's see if that is true. All right. What is 25% of 200 Rand?
100.
25% is 50 Rand. All right. So which means my sales can drop with 50 Rand to 150. All right. If my sales drop with that amount, all right, then my GP is going to drop also. All right. My GP will drop with 25%. So my GP is going to drop to 75 Rand. All right. My cost. All right. Which means my cost is going to drop to 70 there. All right. Now I've got, no. I've done this wrong somehow. It's not working out the way I wanted to do it. 50, no, sorry. I worked it out the wrong way. It's supposed to be, this should be by the contribution margin. All right. So my contribution margin can drop by 50%. All right. My contribution margin can drop by 50% before I run into trouble. So my contribution margin can drop by 50%. So if my contribution margin drops to 50 Rand and my expenses is 50 Rand, then I'm going to break even, basically. All right. And if my contribution margin drops by 50% and my contribution is 50% of my sales, all right, then it means my sales can also drop by 50%. So if my sales drop by 50%, my variable cost drops by 50%, which means my contribution margin drops by 50%, which matches then my fixed costs, that allows me then to get to my to a break even of 0. So in this case, my percentage margin of safety is my profit as a percentage of my break even, of my contribution margin. Does that make sense?
I still don't get the percentage margin of safety.
Okay, so what are we saying? Okay, let's maybe take a step back. All right, the margin of safety is really saying how much sales can drop, all right, by until it reaches break even. That's margin of safety. All right. So essentially what we're saying is your sales, all right, less your break even sales as a percentage of total sales. Your sales less your break even sales. So if you think about this year, right? If you look at this example here, all right, this year is my break even sales because it's 100 Rand sales, 50 Rand variable costs, 50 Rand contribution, covering my fixed expense, bringing a break even or zero profit basically. All right. This year is my actual sales 200. So 200 less 100. Right? That's 100. 100 as a percentage of my actual sales, which is 200. That gives me 50%. So my percentage margin of safety is 50%. I've done it a other way around to bring heightened understanding. And I've said, all right, in this case, my profit is 50 Rand. All right. And my profit here is 50% of my contribution margin. So my margin of safety is actually whatever profit I've made as a percentage of whatever I'm contributing. Because as my profit decreases, so let's say this profit now decreases to 30 Rand, then it will be 30 of 100. It's now a 30% safety. Can you see my profit is decreasing, which means the lower my profit becomes, the closer I get to break-even point.
Yes.
Right? So my margin of safety is really, before I make zero profit, what is that play that I have? Right? What is that movement that I have? How much can I tolerate? All right. Let's say my business stops now. How long must my business stop for before I go to zero profit? If my staff members strike, if there's load shedding, I'm linking it now to the continuity of my business and the reasons why you want to know this information. Right? So if you now say, if we said like we said here now, I've got a 50% margin of safety. And how did I calculate that 50% margin of safety? I calculate it as my profit as a percentage of my contribution. Right?
Yes.
Now, basically, I'm now saying, okay, if my contribution is 100 Rand, and let's say that this was, like we said earlier, this was for 100 products, right? Then I'm saying, okay, if my contribution is, if my percentage of safety is 50%, all right, that means I can actually drop my sales by 50% before I run into trouble. So let's test it. All right. And this is what I tested here on this side. All right. I said, drop my sales by 100 Rand, which means my variable cost dropped by 50 Rand. My contribution now is 50 Rand to cover my fixed cost to end up on 0. Is that good?
Yeah.
All right. So I now let's just jump into, in the last few minutes, jump into B. All right. Recommend to management whether option 2 or 3 should be implemented. All right. In your answer, briefly interpret the contribution margin ratio and percentage, margin of safety which have been calculated in A above, and indicate why this information might be useful to management. Can you understand now, without me even going to B, we've brought about the understanding of what contribution margin means, what contribution percentage means, what margin of safety means, and now because you understand that, when you're now interpreting, like here, option 2 and option 3, you of course want a higher contribution margin, right? Because the higher the contribution margin, the easier it is to cover your fixed costs. All right. And you also want a higher safety margin, because the higher the safety margin, the more room you have to have discontinued operations, as an example, or breaking continued operations, all right, before you run into trouble. So when you are now given these two options, all right, to decide between these two options, you have to understand what contribution margin means. You need to understand what contribution margin percentage means. You need to know what safety margin means. And of course, based on your understanding of that, you'll then give your recommendation. Say option 3 will be taken because, all right, it has a higher contribution margin from less sales, all right, resulting in a higher margin of safety than option 2. Where did this come from? What led you to that? What led you to that was your understanding of what things are, rather than trying to memorize a calculation. In postgrad, you're going to find, and you've heard, I'm sure you have heard it, they speak about the CA of the future. The CA of the future is not expected to do calculations. The CA of the future is a strategic thinker, right? That can interpret information rather than calculate information. And you're going to see this coming through in math. You're going to see this coming through in your assessment question, in all your models. All right. In tax, for instance, all right. I'm not sure about in bridging, but you're probably going to get to that. But in postgrad, if you are asked to calculate the taxable income, then it's like free marks, right? Because why must we be able to calculate? No, you must interrogate, you must critically evaluate the taxable calculation done by the junior accountant and pick up the errors, recommend corrections, all right, and understand why it should have been done in a certain way. Comes back again to this whole conceptual foundational understanding that somehow we sometimes throw by the wayside, and things as simple as an accounting equation, things as simple as what we just did here now, connecting the income statement to what a math income statement looks like, and saying, actually, I know what this is. It's no different to what I've already know. And again, emphasizing the thing that I'm telling you is that I'm not trying to teach you what you don't know. I'm trying to amplify what you do know and make the connections to build that solid foundation. All right. So that doesn't matter which side the question comes from, I'm able to answer it. I'm able to attempt it. I'm able to do what is necessary for it. Was this what you expected? Was it less than you expected? Was it more than you expected?
It was less than I expected.
Huh?
I didn't expect this.
So it was more than you expected.
Yeah.
All right. Does the approach give you comfort, and does it make sense why I'm doing what I'm doing?
Yeah, if I follow this approach, I'll be able to answer theory questions like B, because normally I don't, because I don't understand.
100%. All right. And that's the reason when I said, when I started this section of it, I'm going to jump into the question, but I'm going to bring in that theoretical understanding. All right. So that we can show the application, and you can see without actually going to B, we already in discussing A understood, and it's almost like you're anticipating what the use of this calculation will be, and then you said, oh, yes, B. Oh, I already answered this. Let me just write down what I already know. Awesome. I'm going to leave it there. I think it was a good first session, and I trust that it's also instilled some level of confidence, not only in me, I will appreciate that, but also in yourself, to say that, oh, I actually have the capacity, I have the ability, I am competent, I am able to take this on if I continue on the vein that I am now.
Yeah.
Awesome. A closing remark for you from yourself, and then we can end it.
Yeah, if I practice like this and stop cramming formulas, I'll get most of the things correct. I won't panic.
100%. Right? Remember, I'm going to end with this by saying, when you panic, when you get anxiety, all right, the first thing that goes is memory.
True.
Right? So I'm not saying you're not going to panic. I'm not going to say you're not going to, get a little bit of anxiety in a test or an exam. I'm saying, all right, if you do get it, you're not going to lose anything. You can still continue with the test. You can still continue with the assessment because you're grounded in foundational understanding rather than memory. Awesome. Have a good weekend. We'll be in touch whenever during the week. You can remember, you can always drop me a WhatsApp message or something like that. And when I have an opportunity, I'll respond to it. If we don't chat during the week, we'll see each other on Saturday next week.
Cool, no problem. Thank you.
Awesome. All right. Have a good weekend. And if you're on LinkedIn, please drop a recommendation, drop a experience. Just tell people what you've experienced, and that will be really grateful. I really appreciate that.
Okay, thanks.
Awesome. Have a good weekend. Bye.
Thank you. Bye.